Well, let's get started. I've got some charts here to go over. Um, One thing that I would like to point out here is this breadth weakening of the market that Kevin was talking about. This to me it's sort of a deja vu moment when you think about what happened in 2021 during that market peak of a lot of the technology companies, but really the non-profitable businesses, the times when we had the Beyond Meats of the world finally, seeing their reckoning moment of valuations. And that was a time when most of those companies and even investment vehicles like ARK have not returned to those valuations that we saw back in those days. And instead, what we've seen so far has been a selective number of technology companies that have returned to their, not only to their prior highs, but really been breaking out to new levels. And so you can see in different ways. There's lots of ways to measure. I think last week I had a chart of the Russell 2000 versus Nasdaq. Today, I have here the percentage of stocks above 200-day moving average has been shrinking. It's about 50%. At the same time, if you look at Russell 3000, which is just one of the broadest ways of looking at equity markets in the U.S., it could potentially be called the U.S. equity market or a proxy for that. You can see that the performance has been driven by most of the mega cap companies, but also you can see the divergence that resembles that period of that peak of 2021. So, I think when you start seeing all these signs piling up, it is certainly at least it gets my attention, and I believe that other investors should at least take note of these types of divergences that we have right there. Let's go to the next chart. And so in the next one, we're looking at defensive versus cyclical industries. There's different types of ways of measuring this, but Goldman Sachs has an index that essentially looks at defensive companies versus the cyclical companies, and then it basically excludes commodities from this. And you can kind of see that usually when defensive companies are outperforming in cyclical ones, usually tends to be prior to periods when you have significant sell-offs, and then the entire market tends to fall apart. In other words, a cyclical underperformance relative to the defensive companies is sort of a signal to the market. Again, it could be the same way as the breadth weakening, or just the fact that you're having less and less industries leading the way to the upside, or sectors. And this is certainly the case today. We started with technology, and then you had parts of technology space actually starting to weaken, and then you had the non-profitable companies, and now you're really dealing with the mega cap companies that are on the top, and then you have less, not so much of the Magnificent Seven. It becomes Magnificent Four, and so it's interesting how those things are starting to narrow significantly in terms of leadership in markets. And therefore, I think this chart is a very important one to at least consider as well with the prior chart too. Let's go to the next one. And so the next one is a look back in history and basically seeing how the value versus growth stocks story has been told in a very different way in this last cycle, which has been since the global financial crisis, one of the best periods to own growth stocks in history, as you can see here. Basically, this chart is looking at value versus growth stocks, and it calculates this by looking at the rolling 10-year annualized return spread between these two parts of the market. And so you can see that in prior times, we've had a major outperformance of value relative to growth. In other words, you're being rewarded by being in those earning calls and taking notes and doing your financial analysis and taking a value approach. The whole Warren Buffett, Ben Graham type of investment style to manage capital that has been tremendously successful is what paid off in history. And this period that we're seeing, which aligned with the time when we saw ZIRP, the zero interest rate policy period, driven by central banks because of the amount of leverage in the system and the way they've been conducting their policies. And but now we're not there anymore. We're in a period where rates have been significantly higher, which drives cost of capital significantly higher. And to my, at least my strong opinion is that we're going to see a prioritization shifting back from growth into fundamentals, and really bottom line of companies improving. And therefore, as we see that, the discounting of cash flows of most companies are also going to be re-rated in some of those parts that have been inflated over the years, and most of that is in a growth space. So let's go to the next chart, and you can see sort of this phenomenon in this chart, by the way, because this chart specifically is comparing sort of the same idea, value versus growth, but now comparing it with different economies. And you can see places like Japan or Europe or US starting to see the shift, but emerging markets have always been in that position. In fact, I happen to be Brazilian, so I have a lot of contact in Brazil of folks that manage money and others that follow the markets. And what is not shocking, but interesting to me is the fact that most of those folks from Brazil are very value oriented. If you hear their pitch in a company or anything that is related to the markets in Brazil, it tends to be very value oriented. And I think that's a function of the fact that emerging markets also have higher cost of capital, and therefore it drives this demand of a number of analysts and also money managers that have to have this as an ability in order to survive and really navigate those markets over time. And so we're starting to see that the point of the chart is emerging markets have always been there, and maybe some other developed economies, as we see cost of capital sort of infiltrate in the system, which takes time. You raise interest rates, it takes time for companies to start actually having to roll their debt at a higher interest rate. The same thing is happening with the government. But ultimately, 3-4 years, as we see these rates staying higher for longer, it has an impact in markets overall, and also how we analyze things. Let's go to the next chart. And this chart, we're looking at the PE ratio, but with the forward PE ratio. What I find interesting about this chart is not the dark blue, which is a lot of people are, I think the point of this chart, if you think about it, is really showing the difference between the equal weight and the mega cap weight, or I should say the market cap weight index. And you can see the difference between the two, and reminds you of the early 2000s when we had a tech bubble. To me, the main point of this chart is actually showing how valuations of those mega cap companies are actually very similar to what it was back in the early 2000s. And when I point out this chart, somebody made a comment in this and said, well, what if it goes back to the early 2000s? And the first thing comes to my mind is like, is that your very first takeaway of this chart? Is that we're going to go back to the early 2000s? Is such a that type of behavior to me is classic of where we are in the cycle. Is like, what have you heard of risk reward? I mean, what's the risk reward of going back to the early 2000s versus the risk of something happening? And most of these the success in these companies already being priced into to their inflated valuations that we have. And to me, that's the big takeaway. And so things a lot of times, if we have, let's call it, and I'm not saying we will see this, but let's just say a year from now, we have a major sell-off in markets, 30-35%. Those are the types of people that usually tend to get caught up in those things because they just despite the fact that the index or different types of measurements are signaling that there is potentially people, I guess, I should say, I mean, the suppression of volatility in this environment, along with the valuation being so high, and maybe that's what function one sort of leads to the other, perhaps. The fact that we have inflated multiples also drives the fact that we have suppressed volatility across. But I can't recall really a time in history that we've had this suppression of volatility across so many different asset classes. Regardless if it is oil, even the break-evens, the inflation break-evens is actually very. There's not much volatility there recently. We have the same happening with FX currencies. And so, and I think we're kind of, if I could sort of had a title for this presentation, I think we're sort of in a pivotal moment here for markets. And I'm not sure exactly how this is fully plays out. And I think I'm not in I'm in the same boat with anybody else here. But what I do think it's important is to have at least a sense of where the risk is in markets, and this is one of them in my view, and where the opportunity probably lies ahead as well, which in our opinion it would be mostly in natural resources. But let's go to the next chart. And so in this chart now, I'm trying to kind of look at the liquidity profile of government securities, because if we think about the cost of capital idea and how that tends to have an impact on valuation of companies, immediately the first thing that comes to my mind as well is the fact that we had liquidity sort of drying up in the treasury market. And when I say this is not in to sound alarmist or anything like that. I think that this is shocking to see a chart like this where it measures the bid and ask spread and so forth. And to me, it reminds me of the what happened in the Bank of England back in 2022 when they passed a tax cut. And immediately the prime minister had to resign. And not only that, we had a major spike in the UK bonds yields. And somebody, commented on when I posted this chart and said, how can you compare this with the Bank of England? This is so different. There's no such thing as a sort of unfunded tax cut. Really? I mean, what's happening here, is it not unfunded liabilities at all? I mean, I actually think it's remarkably similar. Not only that, if you look at the interest rate differential of U.S. Treasuries versus most developed economies, I would actually argue that liquidity should be quite high and actually healthy in a place where interest rates in the U.S. are offered at much higher levels than other countries. And in fact, we're seeing this chart kind of show a problem. Not only that, we are aware that central banks purchases of treasuries, despite the fact that it's at record levels today, when you look at that relative to how much we're seeing of issuances, it's a completely different chart. I think that's a more relevant idea personally. Let's go to the next chart. And so here you can see the 2 versus the 30s, or the steepening of the yield curve. I think this is one of the most important signals in the market that I am watching this very closely, because I have a view on this. I think we're going to see a breakout of this chart. And I think this is going to be very meaningful because it's a recession signal. And I think perhaps this is even more meaningful than it was in the past, because this is one of the steepest yield curve inversions we've seen in history, but also one of the longest yield curve inversion problems we've had in history too. And so as we see this sort of, you can kind of see that there's almost like energy being concentrated in this chart consolidating for so long. And ultimately what I think it happens is it breaks out and it moves a lot higher. And so I think this is going to be a changing narrative when we see this chart breaking out. And a lot of people who think that the steepening of the yield curve, which is going to be interesting, are going to see this as a healthy part of the economy because the yield curve is steepening. But when you see that signal coming out of an inversion, it is almost always a recession signal. So I would pay very close attention to this. Let's go to the next chart. And so same, you can kind of see here the yield curve inversions in the past is going back to 1940s. Why am I worried about this as a recession signal? Somebody asked me on an email of this. Well, I looked at this chart, for instance, going back so much in terms of decades in the past. And every time we've had basically a major inversion and the steepening started to occur, that usually is something that you should be aware of, which is very concerning for the global economy or the U.S. economy specifically. Let's go to the next chart. And so in the next chart now, I'm going to go over, I think, 3 other charts that kind of look like this, which, the same thing as we saw the steepening of the yield curve on the verge of a breakout. I've got, 2 other charts on top of this one that also look like this, which is, they could all be aligned. They could all move in the same direction together. In fact, it wouldn't surprise me. And so you can see here, there's quite a lot of negativity recently in oil, and oil has been doing fine, by the way. Oil hasn't, it's been doing just fine. It's been doing clearly forming higher lows as we've had it here. It's been in a downward trend, and it's trying to change that trend. And I think that we can see a breakout. It wouldn't surprise me at all if we see a breakout. And if you look at the energy stocks, they also have been consolidating too. So I think this is a moment of, if you remember how commodities tend to rotate, energy has been on the sidelines for a while. And metals were in the same position not too long ago, and they broke out. gold broke out to new highs. Then we've had copper and others. And now here's energy, and people are just ignoring it again. So this is something I wouldn't be ignoring. In fact, if we go to the next chart, you can see the euro also in the same position. Like I said before, I mean, you would have been expecting the dollar to be, having the move of its life, essentially one of the strongest movements in history. If out of a period where we have interest rates differentials being so steep relative to history. And instead, we're not really seeing this. This chart has actually been building up recently, and which I think it's been trying to bottom for some time now, historically speaking. And if you look at quarterly candles of the euro versus the dollar, very likely is this in line with not in line with the oil trade, but likely in line with other other things, like the fact that we are seeing hard assets is starting to outperform as well. But here's an even better chart, because I don't really like the euro. The euro, actually, if you think about it, I prefer to own economies that actually have a link to natural resources, or I should say their economies are highly correlated to the commodity cycles. And so if you go to the next chart, here is the Canadian dollar that has been not actually doing very well recently. And then you had sort of a double bottom. You can look at the same thing with other emerging markets, which had a really big move for 2 years in the Mexican peso, or you look at the Brazilian real and so forth. And now they also been had their own corrections and sort of kind of resetting the sentiment, which is very healthy in my view. And would it surprise you if we see oil breaking out and we see the Canadian dollar breaking out? Well, the Canadian dollar and the oil if you look at both in a chart, actually the prices of the two have a very similar behavior, and so it makes sense. The Canadian economy is very strongly linked to the oil and the energy space, and so you would suspect that if there is a breakout in oil, or maybe a breakout in Canadian dollar, this would be very meaningful for the two. And also, I should say, for most of the precious metals investors, this is also a very relevant chart, because a lot of the securities that we own are actually priced in Canadian dollars. And we choose to not hedge that exposure because of charts like this. But there's also a whole macro thesis behind this as well. Let's go to the next chart. And now you're looking at a near record short position in the Canadian dollar, which I think adds tremendously to this point. And by the way, I had a chart not too long ago, I think the last week, showing an aggregate of all dollar positions. And they're all, basically markets are very long, or I should say speculators are very long the dollar right now. That's what creates or sets the stage for a short squeeze. And I think we're getting close to potentially one here. Let's go to the next chart. And then the copper reminds me of the gold chart not too long ago. Even I made a joke in the prior week that even my neighbor was telling me about the shortage of copper. And that's when you need a sell-off. You need sort of something to kind of reset expectations. And that whole phrase from Bill Gates that, I don't like quoting Bill Gates. I actually think it's a very intelligent quote, which he says that markets tend to basically underestimate or overestimate the short-term moves and underestimate the long-term ones. And I think this is clearly one of those issues where potentially short-term we got a little bit overhyped, but long-term this looks like a tremendous opportunity. One of the most powerful technical formations, in my view, is certainly the cup and handle. And guess what other metal that has that? Well, it's called silver. It's got one of the largest cup and handles I've seen in my career. And I think this one is a small one, but very powerful. And I would really think that it wouldn't surprise me if we see a breakout, especially from what we're seeing from AI and all the electricity consumption increases that we're seeing, which I'm going to go over that real quick. Let's go to the next chart. And so in this chart, you've seen the time that is required to build a mine. It's now taking about 16 years in this calculation by the S&P Global in order to go from discovery into production. And maybe Quentin can comment on that in a minute here. But boy, this is actually scary. And if you break it down, if you go to the next chart, where does it come from? This 15 years, majority of it, almost 75% of this comes from the discovery phase. Well, and so to me, perversely, this is actually very bullish for the exploration industry, because the fact that we haven't seen all these discoveries plays a role here. And what's remarkable is the fact that we're saying, well, this takes 16 years or so to build a mine. Well, the way they're creating those types of analysis is actually looking back at 127 mines and the development of those mines in different countries over the last few decades. Well, the last few decades, to me, is really an outlier. And why is that? I mean, you saw the chart of growth versus value annualized returns. Well, it's the same thing. We've had zero interest rate policies, essentially, so very low cost of capital. We've had very low energy cost. We've had a very globalized environment. I mean, what if we see the opposite of that? Well, what does that do to the fact of long-term supply in the space over time? And what does that do to metal prices? And then on top of it, you throw this AI craze that we're seeing and the onshoring and central banks buying gold and now looking at metals potentially as a critical metal for as a sort of almost a geographic I guess a global asset that is becoming more and more critical for economies to function in general. And then seeing that the long-term supply prospects of these commodities are just completely stuck in this range right now. And so, in my view, this is actually alarming, but also an opportunity, because high-quality exploration projects are going to be in very, very high demand. And I think if there's one thing we've done very, I would say, right at Crescat has been finding those high quality assets over time. And I think that skill is going to be in very high demand. Personally, it's just my opinion. As we see this world that really requires more supply for metals over time. Let's go to the next chart. And so here you just breaking it down in gold, copper. It kind of shows that the timing. What they say that the gold mines are developed a little quicker, and you would think that copper would take a little longer because a lot of those copper porphyries are deeper and take a lot more capital and so forth. But actually, the timing, I think that the timing is actually remarkably similar, believe it or not, with most metals. Let's go to the next chart. Another one that is interesting is this one, because you would think that underground would actually take longer, but the development phase, the construction phase, it's not really the big chunk of it, as you can see here. Where it comes from, the timing is really on the discovery, is finding the metal. That's the hard part. So, a guy like Quinton, his stock performance should be up every day. If he was a stock, I mean, he should be in high demand. That's my point. Let's go to the next chart. You can see here the global semiconductor industry overall, which, by the way, you can look back here they're in the same axis. So 2015, the global semiconductor industry and the metals and mining industry were at the same level. And now we've seen the semiconductor space grow so much. And so this is driven by AI. And so $6 trillion of that, $3 trillion coming from NVIDIA. And there, maybe there's nothing wrong with the blue line. Maybe the blue line is it is what it is. I mean, we're going to see a world of AI. But what I doubt about it is the yellow line. I just can't believe the blue line stays there and the yellow line doesn't follow, meaning that we're continuing to see all these electricity consumption and the need for all these materials. Now think about all the computers that need to be replaced in order to allow those devices to function in the AI world and so forth, and all these language models. How in the world we're not going to see metals and mining also increasing in relevance is I think it's a big question. And to me, it's not really a big question. It's really a big opportunity. Let's go to the next chart. I'm almost done. Finally, I guess I actually received an email this morning and from an analyst from Haywood, in which provided a link that basically saying that I've seen this survey of the central bank's gold reserves, and essentially asking central banks about very interesting and important questions regarding how they hold, why they hold gold, and different reasons. And this one is actually in particular asking what factors influence your decision to hold gold. And most of the respondents here, so you're seeing the bars, is basically which ones a percentage of those respondents actually answer as highly relevant. And you can see that the big ones here are no default risk, which is the idea of owning a neutral asset, certainly, and the idea of being in a very deglobalized environment. I think that's a very, very important takeaway. The second one, it says performance during times of crisis. Wow. I mean, that is a powerful one, because most 60-40 portfolios are completely ignoring the metal, barely own the metal. And it's interesting how central banks actually have somewhat of an understanding of history. That's why we're seeing this. And then the historical position, which is something that makes gold a very unique asset. And it makes it unique because no other asset has the same level of history as a monetary metal, or a monetary asset, I should say, as gold. And that plays, you can see this is important for central banks. They take note of that. So I believe this is a very important way of understanding how those large institutions tend to think about things. And the fourth one is inflation, as you can see there, which is also relevant.